Well, it's a dynamic that I'm more involved with today probably than I was 10 years ago. 2008 gave me an opportunity to rotate a vast number of my domestic-only holdings, which actually had in some ways run out of rope for reinvestment, and had been making value-destroying attempts, not overwhelming, but certainly important attempts to expand through other businesses or other geographies in a way that wasn't adding value. And in the collapse of the international companies in '08, I resolved to lighten the portfolio with the domestic companies that lacked reinvestment naturally and struggled to reinvest, and put more money to work in the internationals. Now, they've done well, and they've ascended to a very large percentage weight of the portfolio, and in some cases they gap sharply up, such as what Richemont's done over the past several years, and they become, by virtue of that higher valuation, they become a higher weight in the portfolio. And one of the steps that takes place in that environment is that I will lighten up on something that's become a higher weight at a higher valuation than where it was when I started the position. And the proceeds from that go to support just the opposite, a business whose business remains equally attractive to what I thought it was, whose share prices have come down and have in the process become underweight even as they become undervalued more. And so that's the movement of portfolio funds, and that's an ongoing appraisal. As to the degree of sophistication and precision around which investment decisions are based in terms of valuation, I'd say that the metrics are a bit challenging because, as I suggest, very often it's the steps that consume reported profits that are the engine for future growth. And so, and it's very hard to get from a management team. It's rare that you can, the extent to which their investment spending burdens current results. But for me, as a measure of undervaluation, PE, for example, may not be terribly useful, because I may hope that Nestle spends aggressively to exploit the nascent franchise advantages in markets, the spending of which will reduce reported income. And so Berkshire, certainly the second largest holding, has done a tremendous amount of investing that destroys current income. So you can't really look at a PE basis for Berkshire. And with Nestle, I just assume that they don't maximize the E, but actually take steps that minimize the E, which result in a higher PE. So any attempt to sort of benchmark the portfolio's value relative to expectations about what it means to be undervalued, given my preference for reinvestment, and especially reinvestment with a current income burden, kind of stumble. So I really look out 4 or 5 years and think whether or not, if they continue to have investment opportunities and they pay off, what that might mean for the size of future cash earnings is really what I use as my gauge. And that's a subset of businesses that have the capacity to put that kind of money to work and so transform the business in which we invest in by just extending the franchise that we once began with.